start recording. So the plan is to continue reviewing the material. Okay, so there was a question in one of the quizzes that I think we should go through, because I did receive some questions about this. Hopefully, I mean, you all know how to solve this question, oops, by now, but maybe you don't. And so let me make sure to go through it with you guys. So this was in a quiz in the chapter 7 quiz. Oh my God, I keep wanting to switch to pen. It keeps kicking me out of the white screen. So let me do that manually. Okay. So this was a question in the chapter 7 quiz. Okay, I'm not sure what number that quiz was, 5 maybe. In any case, you were given a table, right? I think I actually have this table. I copied and pasted this, but it's not a long table to write out. So let me do that. You were given 2 alternatives, A and B. Minus 50,000 is the investment cost for A, and then minus 50,000 is the investment cost for B. You may have had different numbers, but let's just go with these. $50,000, $39,000. And then I also gave you the IRR for both options. And so this one was 21.98%. And then this one was 23.27%. All right, and I was asking you, let me see actually what the question that I have says. Oh, it says, for what values of MAR? Okay, so I'm asking you to find some values of MAR, or a range of values of MAR for which you would select project B. Okay, so B is our goal here. Actually, let me erase this MAR that I wrote because I need the space. Okay, so that was the question. Hopefully you remember this question. What is the range of values for MAR for which you would choose project B? And so how do we solve this? Any suggestions? Let me switch to blue. What do we need to do?
We do incremental analysis.
Yes, although yes, I mean, we can do that, definitely. But there is an addition, there's a step that we go into incremental analysis. Do you remember what that step was? I mean, we can't do it here exactly, but I want to, like, in general, if I give you a MAR value, let's say I give you the MAR value, and I ask you which one would you choose? What's the first thing you should do before you actually do incremental analysis?
We remove all projects that has less than MAR. The IRR is less than MAR.
Values here, and you compare them to the MAR, because if one of them has an IRR that is less than the MAR, that project is not profitable for us, so we can immediately exclude it, and then we move on. And in fact, suppose the MAR value was 22% or 22.5%. Okay, so this one's okay, but this one is not, and therefore I can exclude A immediately, and I will go with project B, and that's it. I'm done. I don't need to do incremental analysis in this case because I only have one project left, and it's a profitable project. Of course, if you exclude both, right? If the MAR value was 50%, let's say, so obviously both are going to be excluded, and then hopefully doing nothing is an option. Therefore, you do nothing because neither of the alternatives that you have available is attractive to you. And so that's another case. So based on that, if I wanted to choose B, right, before I do the incremental analysis business, is there a condition that I can derive from this initial check on the value of MAR? So based on what I just said, what should happen? How should the MAR value compare to the IRR of B in order for me to choose B?
If you compute the increment and you get B minus A, IRR greater than the MAR, we choose B directly.
But that's not enough, unfortunately, at least for the example, for the case that I have here, because we'll see that later. So I'm asking like just about the initial condition right now, the initial check. Remember, so what Mazen is saying is the following. I check the MAR value. If I'm given a MAR value, I have to check and make sure that the IRR value is greater than this MAR. Otherwise, I would exclude the product, right, if this is not the case. Okay, so in order to choose B, what should be my condition, my initial condition, just from this check, not from incremental analysis. We'll do that in a second, just from this check. What should happen? How should the MAR value of B, I mean, I'm kind of giving it away here, compared to the IRR value of B. Right, I'm giving you the answer, like the answer is right here. I mean, there's no MAR of B, right? It's just MAR, but it should be less than or equal to the IRR of B. Right, that should be my initial condition, like even before I do the incremental analysis business, which we will do. Okay, why? Because again, if the MAR is greater than the IRR of B, B will be excluded. So I will not select B in the first place. And so therefore, my MAR has to be less than this value because I want to select B. So I have to ensure at least that the MAR is less than or equal to the IRR of B. Is this clear to everyone? Because I think this is something some of you had an issue with. You just jumped to incremental analysis. You looked at the condition that the incremental analysis gave you, and you said, that's my answer. But this is also part of the answer. So the condition that I need here, so this is my first condition, and I'll write down here the condition with numbers, maybe at the bottom. So my first condition is that the MAR value has to be less than or equal to the IRR of B, which is equal to 23.27%. So I have an upper bound on the possible values of MAR. Right? Does it have to be less than the MAR? Does the MAR have to be less than the IRR of A as well? Why or why not?
Sorry, Doctor, what did you say? I didn't catch.
B, right? So hopefully we agree on that. Does anyone have a question, or is this part still not clear to anyone? First, before we move on.
Excuse me, Doctor. Sorry for interrupting, but sometimes your voice is a bit muffled for some reason. I don't know why.
Well, thank you for telling me. In that case, I will just remove the earphone maybe and see if. So is it better now?
Yes, it seems okay now.
Okay. Is the first part clear at least? That the MAR has to be less than the IRR of B.
That point is clear, yes. Dr. Ahmed, we can't hear you.
We already excluded A.
We didn't quite do that because like the only thing that I said is the MAR is less than or equal to the IRR of B, which does not, I mean, I haven't really, remember we only exclude something if we want to choose an alternative. If I tell you which one would you choose, A or B, in that case you can, and you have a MAR value, then you can do direct comparisons. It's just number to number, right? Is the MAR less than or equal to the IRR of B? Yes, maybe. Is the MAR less than or equal to the IRR of A? Maybe not. In that case, you would exclude A. But in this case, we actually need to find the MAR value. So we can't exclude anything here. We're actually trying to derive the range of MAR that will make us always choose B. Right? So based on that, should my MAR also be less than or equal to the IRR of A? Is that necessary? Why or why not? Because remember, the initial check that we do is if we have a MAR value, is we compare it to both, and then we exclude, as you said. So should my MAR have a condition that relates to both here as well, to the IRR of B and also to the IRR of A? Like, should I also add? Yes, go ahead.
Both?
What were you saying? Sorry.
Should be less than both of them, A and B, the MAR, to do our analysis.
Why?
To start our analysis and see which one is better.
Okay, so that's a fair starting point. But keep in mind, so let's look at that in a little bit more detail. Let's see what happens. If my MAR is less than both of them, right? My MAR is less than the IRR of A and the IRR of B. So let's say, as an example, my MAR is 15%. In that case, you're absolutely right. I can start my analysis, right? And I can derive the range from the incremental analysis. But what happens if the MAR is, as I said, 22.5%? So it's somewhere in the middle. What happens then?
We choose B.
Yes,
Okay.
which is what we want, right?
Yes.
So we don't really need the MAR also to be less than or equal to the IRR of A. Is that point clear, Khalid?
Yes, it's clear.
Yeah. So I'm not only looking for the range from incremental analysis, I'm looking for generally like what values of MAR would make me choose B. And in fact, if the MAR is in between, it still satisfies this condition here, but it's not less than the MAR of the IRR of A. I will still choose B, which is what I want. So that's great. I don't need the MAR to be less than this value here. I don't need it to be less than the 21.98%. So from these initial checks, I derived this condition, and this is the only condition that I have. Of course, if I had A, if I wanted to choose A, it would have to be less than the 21.98%. But here I'm only concerned about B, so this is my condition. Now we can do incremental analysis. Why? Because again, if the MAR is less than the 21.98%, if it just happens to be 15%, I still don't know which one I would choose, right? And that's why we need the incremental analysis business. So we have a few cases. Like maybe I can do them here. I don't want to spend too much time giving you details, but I want to make sure this is clear to everyone. So let's say the MAR is between 0 or I don't know 0.01, let's say percent, whatever, and 21.98%. If the MAR is in this range, I can do incremental analysis. And as we know from incremental analysis, like there may be a range where I would choose B, there may be a range where I would choose A. So this part is still not clear. I don't know the answer to this part yet. And maybe I can refine this range to suit B better after I do the incremental analysis. And then we have the following range, right, which is to 23.27%. And this range here, we already argued, we would always choose B because A would be excluded. As simple as that. If the MAR is 22.5%, I will just choose B. So this one I'm done with, right? This one I will choose B. Maybe I should write it here, right? What happens if the MAR is greater than 23.27%, right? All the way to infinity, let's say. Well, in that case, the MAR is going to be greater than both of them, so I will exclude them both. So really, I'm not going to choose B or A. So in this case, I will do nothing if I can, which I think was an option in this case. So in order to choose B, so far I have this first building block, which is I need the MAR to be in this range, but I may get something out of this range here, which I don't know quite yet. So now we need to do incremental analysis to figure out if there are more values that we should include in this range. And for that, what should we do? A minus B or B minus A, and why? Yes, Mazen?
We should do B minus A so that we keep the simple investment structure.
But if I do B minus A, I'll get a 0 at the first row, and then I'll get a positive value in the second one.
Sorry, I mean A minus B, the opposite.
Yes.
So we have negative first.
Yes, exactly. So this was like I've included another concept here that we covered. Here you notice that, of course, the way we decide A minus B or B minus A is based on the first row. But in this case, you can see the first row like they both have the same value, so you'll get a 0. So what did we say? Well, we said we have to go to the second row because we kind of ignore zeros, right? And we go to the second row, and here we have to do A minus B to get a negative value because we want our first cash flow to be negative, our first non-zero cash flow. Okay, so that's what I'll do here. I'll do A minus B. I'll try to speed up a little bit. So hopefully you're all comfortable with doing incremental analysis, and that's why I don't need to spend too much time on this. It was this part, I think, that a lot of you missed. And so this is the one I wanted to make sure it's clear to all of you. 11,000, and then you compute the IRR. I'll leave this to you, right? I mean, this is just algebra. I mean, what you can do here, you have 2 time periods, so it's not a very complicated IRR to compute, and you get 10% is your IRR, right? Therefore, again, I'm interested in the range of MAR values for which I should select project B. Based on what I found, what should be the other condition that I can write down? When will I choose B out of this column? This incremental analysis column.
If MAR is greater than 10.
Exactly. Right, so my MAR, in order to choose B, has to be greater than or equal to 10%. Okay, so now I have 2 conditions. One I got from the initial check, one I got from incremental analysis. Right, and I can combine these 2 and I get my answer. To choose B, the MAR should be between 10 and 23.27%. And you can check. I mean, obviously, we argued already that if it's between A and B, if it's between 21.98% and 23.27%, we will always choose B. And we've got the rest from the incremental analysis part, where we said if the MAR is greater than 10, we will choose B because we did A minus B, right? And so therefore, this is my final condition, and this is what I should select as an answer. So a lot, like most of you, I think we're comfortable with the incremental analysis part, but you missed the initial condition, which is also important because you see here, if you're outside this range, you will do nothing, right? If your MAR is 24, 25%, you will not actually select B. So it's not enough to say that the MAR is greater than 10% and then you stop. There's an upper bound, right, for the range of MAR. Any questions on this?
Excuse me, doctor, if MAR is greater than 10 and A minus B, we choose B or A?
So if MAR is greater than 10, so the way I think about it, so I don't have actually the formula ready, but if MAR is greater than the IRR of the incremental investment, that means I reject the incremental investment. So I reject choosing the costlier investment, and therefore I choose the less costlier investment, which is B. Right, so yes, we choose B. So I've went back to like first principle and I derived it, right? Because again, we do usually ignore like the case here where we have a 0 in the first row, etc. Usually, we do costlier investment minus less costlier investment, right? And then we want to decide whether or not we want to accept this incremental investment by looking at the incremental investment's IRR. In this case, the MAR is greater than the IRR of the incremental investment. Therefore, I'm not going to accept the incremental investment. Therefore, I'm not justified in taking the costlier alternative, which is A, right? And therefore, I should take the less costly alternative, which is B. This is the way I think about it, at least. Maybe I've confused a lot of you now, but I mean, you can. So hopefully that makes sense to you, Mazen. If not, I think if you go back to the conditions in that chapter, you will agree that if the MAR is greater than 10, then we choose B.
Yes, that's very clear. Thank you.
Okay, you're welcome. All right, any other questions before we review chapter 9 in the remaining time? Okay, so let me pull up the slides for chapter 9. So this was maybe like one tricky, not tricky, but a conceptual quiz question. And a lot of you have asked questions about this, so I wanted to go through it in detail. So now let's continue our regular review, which was, we stopped at chapter 9. And I'm not sure if we'll be able to do 11 and 12, unfortunately, but if you do have questions, please, I do have office hours after this, so you can ask me any specific questions that you have on chapters 11 and 9. I mean, 11, as I said, is easy, short, but also very important. So make sure, one common mistake, by the way, I noticed this, and of course, maybe you realized this when you looked at the solutions, in chapter 11, in the homework. A lot of you have subtracted, so unfortunately, I don't have the slides for chapter 11 ready. But you guys remember when we did the expenses, and we wrote down the first item is variable cost, and you put down the per unit variable cost in the very first row. And then you have variable cost as the second row, and you multiply the variable cost, which is per unit, times the number of units that you sell to get your total variable cost, right? At the end, when you compute your net income, a lot of you, or maybe not a lot, but a few of the solutions that I looked at, you subtracted also. I mean, this is very hard to do, unfortunately, without slides. So let me do this because this is also important. And hopefully you did realize this when you looked at the solution. You realized your mistake, but if you didn't, I don't want you to make the same mistake, especially since you're doing it by hand. So let me just show you what I mean on a slide. Chapter 11 here. Okay, so let me share. Okay, so here's kind of a spreadsheet, right? This is kind of what we did. We have our revenues here, and then we have our expenses down here. And so this is what I'm talking about. The unit variable cost is the first row. And so you put down the per unit variable cost, which is 15. That's fine. Variable cost here is just 15 times the demand, right? And all of you did that, I think. At least most of the ones that I looked at did exactly that, and that's how you get the 30,000. Now, the key thing is when you get down to the taxable income, which is here, do not subtract this row from the revenues, right? This row is kind of irrelevant now. We just put it there to compute this row. And this row is what you should subtract, right? Because remember, this is per unit, right? And here I just multiply by the number of units. So I have the total. I don't need this row anymore, right? It's just there as a setup. I don't like it, to be honest, but this is apparently this is standard format for these income statements. But I do think this is confusing. Like you should not put it, just compute the variable cost and put that there. But I don't know, I'm not an accountant. But a lot of you subtract it. So when you did this total, right? Or this one here, actually, this is the total of the first two rows. And then you subtracted, let me just erase the pen so that we have less of a mess. Well, it's not letting me do that for some reason. Huh. Can I do it like this? Interesting. Okay. It's not letting me select my pen. So let me actually unshare. PowerPoint. Wait, now my slides are completely gone. What happened? Okay, here we go. Okay. So what some of you did is you took this value here, you subtracted this, subtracted this, subtracted this, subtracted this. This one you should not subtract because it's already here, as I said. This is the point, okay? So make sure you pay attention to that and don't do that because it can throw off. I mean, in an exam, maybe if you make this mistake, you would still be fine because in an exam, you always choose the closest answer. But just to be accurate and to make sure you get the correct answer and that it doesn't throw you off by a lot, ignore this row when you do the subtraction. All right, so that's the only thing maybe I would mention about chapter 11. Other than that, I think it's a fairly straightforward chapter. It builds a lot on chapter 9. So let me switch to 9 in the remaining minutes because I don't have a lot of time, unfortunately. And let's briefly go over chapter 9, but let me start by asking you if there are any specific questions in chapter 9 that you would like me to go over or any issues that you would like me to address. Okay, mid-month and gain. So Mohammed, I think, has been waiting for that from the point at which like the quiz ended until now. So let me skip to that because I want to make sure I address those issues. Yeah, so gain was an issue, like even for me apparently. So I can understand why it's a tricky concept. So let me do the mid-month one first, maybe. So the mid-month convention only applies, first of all, to real property. And remember, real property, let me go back here. Wait, not here, here. Real property are things that can't be moved, right? And those usually are buildings. And the buildings can be either residential or non-residential, right? And the only thing that differs between them is in the recovery period, as you see here, the number of years. Right? Other than that, we treat them the same. We always have the mid-month convention. So how do we solve problems with the mid-month convention? Well, the problem usually will tell you when a building was bought. So in this case, if you read the example, it says on May 1st in a particular year, Costanza paid this much for a residential rental property. So this again is real property. It's of the residential rental type. So its N is 27.5. Yes, Mohammed.
Yes, doctor. Actually, my problem is to find the fraction to multiply with.
Okay, yeah. So I'm getting to that. I'll try to like just summarize the example, just to show you how you can get the fractions. Yes. So here May is when the thing was bought. So May is the 5th month, right? In that year in which you bought it, right? You're gonna, of course, first of all, we apply the mid-month convention. So here, even though the asset, the building, was bought on May 1st, we're gonna assume for the purposes of taxes that it was bought, let's ignore this for a second, it was bought on May 15th. Now, in that first year, you owned the asset starting from May until the end of the year, right? And then the following year, you owned it for a complete year, etc., until you sell it. So to find the fraction, we have 12 years in a month. You need to look at just the number of months that you owned the asset for in that first year. Well, if May is the 5th month, right? So I owned it for 6, 7, 8, 9, 10, 11, 12. So that's a full 7 months. And then I owned it also for half of May, right? Because I'm starting on the 15th. And that's why the first fraction should be 7.5 over 12. Same thing, similar thing, not the same thing, but a similar thing happens when you sell the asset. So here the asset is sold, well, 9 years and 5 months later on October 1st. So this is the date of sale. And some other year, 9 years after the year of purchase. Again, for tax purposes, I'm going to assume that this is October 15th. Right? If I sell the asset, I own it from the start of the year in which I sell it until I sell it, until it leaves my hands, right? How many months? Well, there are 9 months total, right, from January until September, before October. And then there's this half month in October, the 15 days. So my fraction for the final year is going to be 9 full months plus the half that is in October divided by 12. Right? And that's how you get the fractions. And so then I'll take my depreciation rates and I'll multiply them. Oh, well, that's an issue. If you don't know the month number, you should start memorizing. Or I guess you can ask me in exams. I mean, you should really know the month numbers by now. Otherwise, I mean, how are you managing your life? I don't know. Very interesting if you don't know the numbers. You don't use dates? I don't know. Like I don't like I'm not meaning to make fun of you. I'm just like very curious to know if you always just write down the name of the month. I guess I'm not sure, but you should know. Unfortunately, otherwise you can ask me. Like if you just want to be sure, like I'll just tell you. That's fine. But I mean, I don't know. Like if you go to a company, like if this is going to be a reasonable situation for you. Yes, Mazen.
Yes, doctor. If we sell the real item, if it was sold on September 30th, how will it change? Just 1 day before October 1st.
You would still apply the mid-month convention. Oh, well, yeah. So you'd still do that. So now, so Mazen's example. So let me say. So Mazen's saying if I sold it on September 30th. First thing you do is you move this to September 15th. Again, by the mid-month convention. Now the fraction is going to change. It's going to be 8.5, right? Not 9.5. So the fraction here is going to be 8.5 over 12. Right, so even though it's 1 month, you're right. Like just not 1 month, 1 day before this one, it changes drastically in terms of depreciation. This is how tax law works, apparently. Okay.
تمام واضح. شكرا.
عفوا. Muhammad says, look at my screen. I can't look at your screen, but maybe there's a story there. In any case, I have 1 more minute, so let me talk about gains briefly, and then I'll continue talking, and you guys can leave if you have other engagements. So for gains, again, let me reiterate the point that we always compute gains taxes when we sell or we dispose of an asset, right? When we have a salvage value and you sell the asset, regardless of when you sell that asset, before the recovery period, at the end, after, doesn't matter. You always compute gains. The way you compute the gains is you take salvage value minus book value. That's always going to be the formula, right? Even in this case, like here we have 2 cases, but you see even in the second case, it's always salvage value minus book value. The second case really relates to how you tax it. This breakdown may be relevant for taxes, and I'll talk about that maybe briefly in a moment. Okay, but the formula is salvage value minus book value, always. Of course, it may be 0 if the 2 are the same. In that case, you don't have any gains. Therefore, you do not have any gains taxes. It may be positive, it may be negative. If it's negative, we have a credit. So make sure you indicate that with a minus sign, or you treat it like accurately in your statement. So you get the correct final answer. Again, we have 2 cases, depending on how the salvage value compares to the initial investment cost. Right? So the salvage value can be less than the cost basis. So the cost basis, remember, is the cost of purchasing the asset plus all of the other costs that relate to purchasing the asset. So that can include shipping, installation, etc. So if you sell it for less than the initial investment, which is probably usually the case, right? You buy a car for $50,000. I mean, that's an expensive car, but you buy it for that amount, you're usually going to sell it for less than that. But in some cases, you may actually end up selling it for more, depending. But in general, we're in case 1, right? And I think most of the examples we have seen were case 1 examples. I compute the gains using salvage value minus book value, right? If this is positive, I apply my tax percentage. And when I say ordinary gains, I just mean use the tax percentage that you were given for income, right? So if I tell you that the income tax is 35%, just use that directly. 35%, I apply it, I get my gains tax. I'm done. For the second case, if I sell it for more than what I initially bought it for more than the cost basis, the formula again is the same, but here I can have an additional breakdown. Here you see they just subtracted and then added the cost basis. The reason why is because sometimes, these have different terms. So if you look at the salvage value minus the cost basis, this initial term, it's called capital gains. If you look at the cost basis minus the book value, this is called ordinary gains. Why do they do this? Because sometimes this has a different rate than this one. We haven't actually seen that. I think in tax, in the US taxes currently, they both have the same rate. So you don't really need to do this step. Right? You can just do salvage value minus book value. Only do this step if the question tells you capital gains are taxed at, I don't know, 20%, but ordinary income, ordinary gains, are taxed at a rate of 30%. Then you have to split this amount into 2 parts and tax them differently. Okay? But if you're not given 2 percentages, if it's always just 1 percentage, you can just do salvage value minus book value and apply the percentage. All right, so here's the picture, and I'll leave this to you. Here's another important point about this, and that is when you sell the asset before the end of its recovery period, the depreciation that you claim in that final year has to be divided by 2, which I mentioned at the beginning of the class, because we want to establish the half-year convention at the end, even though we're selling the asset before the end of its recovery period. Of course, if you keep the asset all the way until the end or beyond of its recovery period, you don't need to do that because it's already done in the table for you. So just keep this in mind because this is also very important. And this only relates to the case where you sell the asset before the end of its recovery period. Let me just show you this example. Maybe Muhammad, maybe it helps because this has all the cases. right? So here we have a drill press that is bought for $230,000. This is the cost basis, the initial investment cost, right? It's sold at the end of year 3. So immediately when I say sold at the end of year 3, and I tell you it's a 7-year maker's property, you can deduce immediately that I'm selling it before the end of its recovery period. So I have to be careful with the depreciation in that 3rd year. I need to divide it by 2. Okay, so that's one very important thing that you need to know. And also I tell you, so here you see the case where I tell you the capital gains and the ordinary income are both taxed at the same rate, 34%. So in that case, I do not need this line here. I can just do salvage value minus book value and multiply by 34%, because both capital gains and ordinary gains or ordinary income are taxed at the same rate. So let's look at cases. Oh, first, let's compute the depreciation. So I go back to my makers table. I find the 7-year column. I put down the percentages. Okay, all the way till year 8. I have to divide this one by 2. Okay, and that's what I do here. And I find the total depreciation only for the first 3 years, with the last one divided by 2. I compute the book value. Remember what the book value is? It's just the cost basis minus the total accumulated depreciation. So I computed the depreciation here, so I will subtract it from the book value. And I will get my book value. I will subtract it, sorry, from the cost basis, and I will get my book value. Now, in order to find if there is any gains tax, right, I need to do salvage value minus book value. So here, actually, we have cases. So case 1, let's assume that the salvage value is 150,000. It's not the same as the book value, right? Therefore, there will be something. I mean, clearly there will be a gain in this case because it's salvage value minus book value. So you see here, we'll have a positive result. So I do salvage value minus book value. I find the value, and then I tax that at 34%, and then I'm done. Right? I can also compute the net proceeds from sale, which is just looking at the salvage value, how much I sold the asset for, minus the gains tax. It just gives you sort of the net income that you get from selling it after taxes. Right? I don't think we usually ask for this, but just know how it's computed if we do. Let's take another case. What about if the salvage value is the same as the book value? Well, in this case, I again do salvage value minus book value, but I get a 0 because they're both the same. So no gain, no loss. What about if the salvage value is 100,000? Well, my book value was greater than that, right? So again, salvage value minus book value. So I'm going to get a negative result here. So salvage value minus book value, I get a loss, which is fine, and actually it's great because I get a credit. So I still multiply this by 34%, but now the tax that I have to pay is negative, which means I get money actually, right? And again, if I compute the net proceeds from sale, I add it. So you kind of mechanically you follow the same steps. Like the negative is just there, right? But here you're still subtracting, which is the same. You're still multiplying by 0.34, which is always the same. So you just follow the same steps. Just keep in mind that you get a credit. Finally, in case 4, this actually corresponds to case 2, where the salvage value is actually more than what you purchased the item for, because remember that was 230,000. Okay, so in this case, you can do this, right? You can do the decomposition, right? You first compute the capital gains, which is this first part, and then you compute the ordinary gains, right? And then you add them together. It doesn't really matter. You don't have to do it this way. You can also, same way, you can do salvage value minus book value, same as before, right? That should give you the same answer. So yeah, if you do this here, salvage value minus the book value, that should give you the same answer. And then you take this amount and you tax it at 34%. And similarly, you compute the net proceeds, same as before. Right? Did that help, Mohammed? Did that clear up the issues that you've had, or do you have any specific questions maybe that I?
Yes, it helps a lot. Thank you, Doctor. And one more question.
Yes.
Is the gain only for the final year?
Yes, because it's when you sell the asset, right? So in the income statement, like in chapter 11, let me just erase this and I'll do this on the side. right? So suppose the final year is 5, you will only put the gains tax in the final year because that's only when you sell the asset, right? In whatever year you sell it, 5, 3, you just put the gains tax there.
Yeah, that's clear.
Okay. Any other questions, guys, on Chapter 9 or just in general that I missed that you want to ask right now? Yes, Mazen, go ahead.
دكتور إذا if we sold the asset after the recovery period, what would
Yes.
change in calculations?
So if you sold it after, in that case, I think it would just be fully depreciated, right? So you, the book value is essentially going to be 0, right? Because remember, in the makers, the salvage value is assumed to be 0, right? And we fully depreciate actually the full cost basis, right? So we take I, the cost basis, and if you add up all the percentages in the makers table, it will give you 100%. So the book value at the end, like in year, let's say in this example, so this is a 7-year property. Let's say in this example, I sold it in year 9 or 10, just for the sake of example. The book value is going to be 0. So the salvage value minus the book value is just going to be the salvage value. And then you just pay gains tax on whatever that is. And I think that was actually the case that we had in the second question in the homework, I think.
So what is the difference between if I sold the asset on the period, the recovery period, or after? It would be also the same 0 book value.
As far as, well, it depends on what you mean by on the recovery period, because remember, like the recovery period is like, let's take this example. I mean, here there's a small technicality. This is a 5-year asset. So if you sell it in the 5th year, right, because of the half year, the weirdness of the half year convention, actually you have to be careful. If it's in the 5th year, you have to divide by 2 still. If you sell it in the 6th year, which is really kind of after the recovery period, right? In that case, it would be the same. So if you sold it in the 6th year, the 7th year, the 8th year, you will always fully depreciate the asset in this year here. So whether you sell it in this year or 7, 8, 9, 10, the book value is always going to be 0. Did that answer your question?
Yes, yes. Thank you.
Okay, yeah, just be careful about the 5 here because it's kind of weird. But yeah, you're right. So 6 and above. Basically, 6 means we used all the percentages in the table, right? So 6 and above, the book value is going to be 0. Yes, Mohammed?
Yes, Doctor. I would like to ask about the question that requires to find the economic service life in today's quiz.
Oh, okay. So let me pull that up. So any other questions maybe generally about the material before I close the slides and talk about the quiz? Anyone? I mean, if you do, you can always ask me in office hours because I need to stop recording now maybe.